Simon, let's start with you. The onus is on the Fed to step on the brakes even harder.
Absolutely, and it's tough for the Fed. They made a huge error in perhaps buying into that transitory argument that we heard all through of last year, and as a result, they're up against it, and they are, to some extent, the decisions are becoming quite easy. 75, likely 75 again, but it's going to become tougher for them. The inflation, you said in your introduction that it was supposed to have peaked again. The data still keeps coming in strong. A lot of forces providing strength, and at the same time, the economy is starting to show some signs of weakening, and so those decisions for the Fed going forward, starting with next week, going to become even tougher. It's almost the case that it was easy to go hard. When do you ease off? Can you ease off?
75, some say it will take 100. It is about the Fed credibility and the dot plots in focus next week.
Yeah, I completely agree. Look, I think the probably part of the reason why the market was lulled into an expectation that CPI would continue to ease off is largely around energy prices. Oil prices have been under a lot of pressure for a number of reasons, partially because Russia has been exporting a bit more oil to the market, and Chinese demand for oil has been much weaker because the growth recovery there has sort of been a bit disappointing so far. I think this is the key risk now is for the Fed is that core inflation is rising, and we know that rents and et cetera in the US continue to rise. Housing stock in the US is pretty tight, but having said that, the key risk now is, and we think that oil prices go back to around 125 by the time we get to the first half of next year. That's a re-acceleration of gasoline prices, which slows down that decline in headline inflation. So while it may seem like the Fed is facing, a lot of problems right now, if those oil prices go back to where we think they will, then gasoline prices, et cetera, will start to put upward pressure on headline.
The thing is, Nomura says that part of the reason why inflation is so high is that expectations have gone higher, and that is a huge headache for the Fed.
Absolutely. You saw earlier in the week expectations had actually come back down, and everyone was starting to celebrate that into the report yesterday. But yeah, there's this big concern about it, expectations. Nomura were right on 75 earlier in the season. They got the timing wrong, but they were right that that's where it would eventually go. Larry Summers also talking about 100 basis points next week. Perhaps too soon, but they moved to 75 from 50. Whether that's a debate, we'll have to see.
This is a good question to, I'm going to say the red corner or in the blue corner, but Wayne's not wearing blue apart from his suit. But Wayne, tell me, I'm going to use, it's a Mike Tyson there, as I was saying earlier, and to carry on with the boxing analogies. And Wayne, he said when you've got a plan, but it exists until you get punched in the face. The thing is, we're looking at these August figures, but September could show a marked downshift with a lot of the indicators suggesting that in CPI. What do you make of that, and do you agree?
Yeah, so I guess I allude to the answer before, Rush, actually. So I think the direction of oil prices here is going to be key also to expectations, as you were just talking about before. For us, as we go into next year, the supply side risks continue to be a real issue in the energy market in particular. And let's not just talk about the energy market, let's talk about agriculture. The USDA released their report on Monday, a significant downgrade to soybean production in the US, another downgrade to corn production in the US. We have a La Nina event around the corner again, if we believe the Bureau of Meteorology in Australia. This tends to see food prices and grain prices tend to be higher in these events, not lower. And we already see the geopolitical risks impacting from the ongoing war in Ukraine. So food prices, which again featured actually in the CPI last night, food prices, wheat prices, grain prices have been under pressure for the last few months. If they begin to turn around, well, then this could be a double whammy for central banks like the Fed.
Speaking of central banks, Simon, how do emerging market central banks even keep up with the Fed? I mean, add to that strong dollar environment, emerging market currencies will be under a lot of pressure.
Absolutely, and you've seen actually the emerging markets, Latin America, Asia, they were kind of quick on the uptake. They were raising in some places faster than the Federal Reserve, and yet they still have that pressure being imposed on them, as you say, through the channel of the dollar. As the old line, it's our currency, your problem, and so that's certainly the case for several emerging markets. Some of whom, and perhaps more on the frontier space, we're already seeing those traditional phone calls to the IMF occurring.
The yen, the yuan, there are lines in the sand right there. Can the central banks defend those levels?
I think this is really interesting because firstly, the Bank of Japan has made it very clear that they're not going to move from their current position, at least over the next few meetings, or at least until Governor Kuroda hangs up the boots and passes on to somebody else. So the yen is going to be primarily driven by the widening yield spread between the US, and that is a lot dependent on the Fed, not so much on the Bank of Japan. I think for the CNY, the key issue is that there's going to have to be ongoing support, not just from the fiscal side, but at least something from the monetary side. And as I said earlier, growth hasn't come back as quickly as what we would have thought. So it is a fairly weak picture for these currencies looking forward over the next 3 months. I'll just pick up on something with respect to emerging markets, though, and with respect to Asia. So we've seen, for example, the Indonesian currency holding up pretty well because coal prices have been very, very elevated. And so that's been supporting their current account positions. But of course, if coal prices do start to come off the boil, some of these countries' current account positions are going to start to look pretty difficult. And that means that not just the central banks out here will be hiking because of maybe a bit more inflation in the system, but they may also have to move into defending the currency mode. And so this interplay between the Fed and these central banks is going to be really interesting over the next 6 months. And certainly there are those countries which are further advanced in the hiking scenario, such as Korea, where they're facing a lot of trade headwinds, a lot of headwinds on the tech side, and not only that, but if they now start to get a little bit more balanced in their monetary policy view, you could see a bit of weakness on things like the won as well.
This one to the red corner, Simon, looking at the yen in a bit more detail here. I mean, it's like trying to face up to a runaway train, the dollar, but they keep doing the same thing, and verbal intervention thus far has been, well, tepid, and I'm being polite.
But perhaps, and in some quarters, that's the accusation. The thing is that the currency, everyone talks about the Plaza Accords and interventions of days gone by. It's a much tougher environment for central banks, the Bank of Japan, even with more money in its reserves, to be able to fight against Mr. Market, so to speak. And the challenge there will be, if you turn tougher with verbal intervention, the question comes, well, what have you got behind it? So perhaps that's part of their strategy. If they come out tough verbally, then the pressure just comes on to put money where their mouth is.